Hey guys, welcome back to the channel. Thanks so much for clicking on this video. I really appreciate your time. I'll try to provide as much value as I possibly can. I'm Nitin Gupta. I work as a research analyst for a hedge fund called Ticker Trends. We're going to cover DBOX. So if you didn't watch my initial video that we did 2 weeks ago, we had projected that the earnings for Q4 are going to be really bad. The stock's going to drop 25 to 30%. It dropped 28%. And I had said that 24 cents is where I'd be bidding. It seems like other people are also bidding that same level because 22 cents was where the bottom happened and the stock rebounded. I was able to size up into the position as I had shared. I think there's a catalyst coming very soon in the next like 6 months potentially that'll take the stock up 50% from here. In a very short period of time. No financial advice, but I'm quite certain about this position, and I've not had so much conviction about a position like in a long time, especially given the valuation. And we'll talk about the valuation here in this video, and also talk about the Q4 earnings. We'll also talk about the earnings going forward, how I see the future of this company playing out. And yeah, like we'll just talk about valuation and what my targets are for the stock. And I do believe that this is still a 3 to 4x. My price targets and my conviction has actually gotten bigger than it was in the last video. So yeah, we'll talk about this. So yeah, first of all, I want to talk about the right for use, rental, and maintenance royalty. So if you don't know anything about the business, basically DBOX sells haptic technology seats. They install them at the back of the theaters. They used to do the back of the theaters. Now they're doing it like in the middle of the theaters. And every time someone uses these seats, it's like it basically gives you like a 3D, 4D type experience when you're sitting on the chair. The chair moves based on the action that's happening on the screen. And this technology is like quite useful in sim racing as well. So the right for use, rental, and maintenance is just the royalties income they get from anyone coming in, buying the ticket. Every time someone uses a DBOX ticket in a Cinemark, a DBOX gets a royalty portion back to them. And this is the main reason why they've been able to drive up so much operating leverage and be able to just to scale the business. So in this quarter, like I personally thought the right for use, rental, and maintenance income is going to be lower, but this tells you that even though the release schedule is so weak, which we also talked about in the last video, they were able, the installed base is obviously helping them, and also it seems like the utilization is very strong because Cinemark and the other customers that they have are not only installing them in like the new theaters that they're making, they're also upgrading their old theaters and installing DBOX seats in there. The reason, basically, as I talked about last time as well, it's the ARPU, it's the average revenue per user. If they're using a normal seat, it's going to be $10. If they're using a DBOX seat, is going to be $20 minus maybe $2 of royalties back to DBOX. So I mean, they don't have to do anything else, but they get all this incremental revenue. And why wouldn't you, right? Like the popcorns and drinks and everything else are so expensive. So this is another way to enhance your revenues. The seats you're paying, it's like an asset. They don't go away for the longest time, and you're maximizing the ARPU per customer. So in the last video, I talked to you about the alternative data regarding the sim racing search trends. So you'll see the sim racing search trends have been parabolically going up recently, and I believe that they're gonna keep on going up. So I'm an investor in Liberty One Media company as well. I see like the sim racing is the red trend here, and you'll see how it's just in a stepwise way it's going up. The trends for DBOX as well are pretty strong, and yeah, they'll probably continue to do well. And these trends are choppy based on the kind of movies that are being released in the theaters. So that's one thing that their business depends highly on. But yeah, the sim racing trends are very strong, and if you follow Formula One, they've been talking about making like these facilities where you can come in and have sim racing experiences and stuff like that. So they're doing a big one in Vegas, and I'm sure the reception for that one is going to be really good, and they'll probably roll it out in like other countries, other states in the states, in the United States. And I think the appetite for the sim racing portion of this business is also going to be very strong. And we saw that this quarter, right? Like the growth in this particular segment is 108%. Again, it's a lumpy business, so we don't really know if this is gonna continue going forward. But like overall, this entire year it was up 41%. So I think this is one part of the business that'll keep on growing going forward. And yeah, like the theatrical releases that we talked about in the last quarter, like this Q1 is coming in. So I realized my mistake last time, and when I got done with the video, I didn't realize that these numbers were actually for the entire globe, and these numbers this time I've tried to correct my error, and these numbers are only for US. So I think, let's say even if this number was double, like they're tracking at 3.6 billion for total grossing movies over this this quarter. So it's probably going to come in at like 3 to 4x. I think it's not going to be fair to put a 3x multiple on this, but at least 2x multiple is justified. So they'll definitely have that 2.3 million dollar tailwind in the next quarter, which will come in. And also the couple of huge news came through. So one that we talked about on the last on the last video, that they got 70 more DBO haptic enabled screens across as many as 25 Cinemarks in the United States in the next 18 months, predominantly in theaters that have yet to experience DBOX. This expansion represents a significant investment and marks one of the largest multi-site expansion of DBOX screens in recent years. Notably, the expansion will increase Cinemark's worldwide presence to more than 500 auditoriums, further solidifying its position as the exhibitor with the highest DBOX penetration. So again, like what I said last time around, Cinema keeps on buying more and more of these these seats and more of their screens. Obviously, like these Cinemarks and all the theater companies, just after COVID, they're very constrained in terms of capital. So like the capex is not that high. So the TAM is very small, right? You probably have maybe 8 to 1,000 screens every year, and like they only have 100 screens per year right now. This is the second deal that they got with Hoyts. They were in 25 screens before. Now they've gone up to 44. So there's another 80% increase for Hoyts, and this is again, this is just proof of concept, right? Everywhere that they're installed, they're getting more and more orders from. So the run rate for this year is probably going to be 100 screens at least, and that kind of ensures that you'll get to at least $10.5 to $11 million for the theatrical side of the business. The simulation and training, they are putting in new generation seats in for these ones as well. So there's some replacement cycle stuff going on. Probably, let's say, even if this is flat for this year, sim racing will probably grow at again and at least 15% this year. The other business is going to get faded away. This was just direct to consumer business that's probably not going to be there next year. So we're still looking at around $33 million in revenue next year. So if you put this at 33 million, right, and then the rights for use rental in the royalties income is probably going to come at 13 million at least. The reason why I'm saying that is because of the fact that the install base. So you already have 9% more seats. So even if we have the same capacity utilization, same everything, no price increases or anything else, that gives you a 9% increment right away. And then there's going to be another 10% increase this year. So you're basically sitting at 20% increase right away without saying the price is going to go up and anything else. So, and this is basically the strategy of the company, right? They don't really want to make money from this portion anymore, from the theatrical portion. They're trying to make money from the royalties. And as I said in the last video as well, a royalties business will always be valued more richly as compared to just a B2C, a B2B business, which doesn't have much going on for it. So I think this might be a little high just to be conservative. We'll just say revenue for this year probably comes around at $45 million. So I think that's quite I think that's quite reasonable to say so. And again, I know the board is trying to right now they're doing 100 screens per year. I'm sure they're trying to get it to 150 or 200. The way they do it, we'll find out soon. But if they are able to do it and this revenue goes up to 60 million, then we're laughing. We're laughing to the bank. This is already very cheap. And if we can get another $5, $10, $15 million increment, because every incremental screen that they get installed in, this royalties business starts to explode. And this is more of an annuity business as well. This is income that's going to flow into the company for years on years, and that is almost pure cash flow. So this is really, really interesting, and how they play this out is going to be really interesting as well going forward. So if you look at the valuation, I mean, I feel like this valuation is extremely cheap. You're looking at revenues of $45 million, so you're trading at 1.3 times revenue. You have free cash flow generated this year, about $6.5 million of free cash flow this year, and it's next year is probably going to come in at say 8 million. So you're looking at a company that's trading at 7.5 times 7.5 EV to free cash flow. So I mean, that's also it's very cheap. 8 times free cash flow doesn't happen for a small cap. And this company, again, it's just generating cash. And this is where I'm going to talk about the catalyst. So due to this, I feel this was teased in the Q3 earnings. They didn't have a Q4 conference call, so there's no way to know on the update on this. But I do believe in the next 6 months we will see a buyback being announced. Now, the buyback for a normal company, for a large cap, doesn't matter. Like, it does matter a lot, but it doesn't matter as much as for a small cap and a micro cap like D-Box, which doesn't have much liquidity in its stock. So imagine if it's announced that we're gonna put a buyback facility. They have $6 million on their balance sheet right now, so they have a net cash of about 6.5 million, and we're saying they'll probably generate another 8 million. So you get to like 13-14 million. Your market cap is only 60 million, and you have like almost say like 14-15 million dollars in cash. They announced a $15 million buyback facility, buy back $5 million of stock. Let me tell you, there's no stock available. You cannot buy this stock like in any meaningful amount by putting like market orders. That you're just gonna increase the price by a couple cents. Like that's like 3-4%. So you have to put limited orders in. There's not much stock out there. A lot of people who are in this stock, from what I've seen after the flush out after the earnings, are very savvy people, because I tried to put some aggressive limit orders in, and they just wouldn't fill. Because I mean, no one wants to sell the stock because everybody knows it's cheap, right? So if you're looking at just for projecting this forward, you're looking at 6 times EV to EBITDA. You're looking at potentially 1.2 to 1.3 times revenue. You're looking at less than 8 times free cash flow, and you're looking at 10 times earnings. So I mean, every metric here points towards massive undervaluation. Like I could with the royalties portion, I'm not surprised if this business is trading at 25 to 30 times earnings. Like just the way it sits right now. Maybe 25 is too rich, but even 20 to 30 times earnings. Like you're looking at right now, you're looking at a 2x without seeing the how the new releases and how the successful releases are going to impact them in the next 4 quarters. So I feel like this company could easily 2 to 5x, 2.5x in a very short period of time. Once we do see like the momentum into next, into next year, and we see the EBITDA, which is it's probably sitting at 9.5 million for this year. 6 times EV to EBITDA, it's not that expensive. Again, any way you look at this, you're probably looking at least 2.5x. And if the business improves, if they're able to get to instead of installing 100 screens every year, if they get to 150 or even 200 screens per year, then you're looking at like a potential 5 to 10x. I mean, 10x is probably like the best case scenario. They do something just the execution is just unreal. But the buyback catalyst alone, just the fact that a small microcap listed on the Toronto Venture Exchange, has put in a buyback, is generating free cash flow, will get a lot of investors attracted to this company. And I can assure you this thing could double in a week. So I am in long in size. I will keep on adding shares if I get a dip. I want to own as much as possible. So yeah, I'll share I'll sell some other stuff to buy the stock. If things don't materially change, if we have another pandemic, I mean, this thing could probably go to be cut in I don't know, half, even more than that, right? So there is that possibility. But given the fact that it's going away from the theatrical side of stuff as well, and it's going into the sim racing and everything, and I mean the sim racing business was actually almost the size of the theatrical business last year, and this is growing the fastest, right? So you could have an acquisition done by either Formula One, I think, which is also a public company and is known for doing acquisitions. They are very shrewd capital allocators. Formula One is. All Liberty Media companies are, honestly. All Liberty companies are just amazing capital allocators. So I won't be surprised if they come in and just buy out the business, because it would make a lot of sense for them. It's very synergistic. Or Cinemark, which is 50% of their total install base, right? Why wouldn't they want to just come in and buy them out, and just instead of paying these royalties, why wouldn't they just pocket everything internally? So that's the other catalyst. But I think those two catalysts alone, for value unlock, one is the buyback. Again, any news, there's this company that I shared on my X. I'll leave the link for my X in my description, that I shared last year. The name of the company was Beware Holdings. It was richly valued, but there was a buyback announcement, and they were actually actively buying shares whenever the stock dropped. And there was just a bid. There was a constant bid, and people knew that, and they were able to they were able to I think 2x or 2.5x the stock price in a very short period of time. So I do believe, if we have some sort of inflection, if we go from 100 screens to say 120, 130, 150 screens, and the sim racing business also continues to grow, which I anticipate is going to happen given the trends and how strong that portion of the business has always also been. Plus, you have the royalties, which will keep on going up as they put in more screens. and also like the release schedule is really strong, as we talked about in the last video. So you have a pretty decent company which has, you know, a good revenue base. It has good quality of earnings with its royalty portion, and you're looking at like $45 million in revenue, potentially trading at like 1.3 times like revenue, and like less than 8 times free cash flow. Like, you're looking at a very cheap company, I feel like, with a business which has a huge moat around it, which is going to grow, you know, earnings very, very strongly. It's going to grow its cash flow. It's going to grow EBITDA, so, and it's already net profit positive, and it's going to keep on growing those earnings, because now they have this massive operating leverage due to these royalties. So that's the other portion. I'm maybe I'm like being too overconfident about this one, but I do feel quite confident that I'll probably at least get a 50% in the next 12 months, and I'll be happy with that result as well. And like, the sky's the limit. If we have some really positive inflections, if we start seeing more theaters coming in, right? If we start seeing things like that, where like the sim racing business takes off, the buyback comes in. I mean, like I really like my odds of making money on this company. Again, it's not investment advice. It's just my own understanding of the business and how I see it playing out. And if there's any stock out there, at least there's one person, and I know a couple other people that, like, in my groups we've talked about, that will be betting it. So I think there's a good bid under it. There's a very strong and smart capital base or investor base, and also the company is gonna step up. Hopefully, it's buyback. I don't know for sure, but I do believe that news is coming at some point in the next 3 to 6 months. So I think watch out for that. I really appreciate you if you're still watching. Please subscribe to the channel. Almost 80% of the people who are watching this video are not subscribed, so I would really appreciate if you leave a subscribe and a comment as well, and a like as well, please. Thank you. Take care.